All right, here we are again. So we've got pretty much everybody here. Good. So what I've done is I've put together, because we, at some point have to have a midterm, for God's sake. Yes, we do. So what I've done is I've posted onto Moodle. Let's go look at it. The first step in that direction, which is a problem set, which is based on exclusively on chapter 2, way back in the beginning when we were looking at international trade. All right, let me get myself logged in there. And so, let's see, here it is. So this is the chapter 2 problem set. Now, if you look at it, you'll see that it's all about comparative advantage, which it's been a while since we did this, but you should have no trouble with this. Now, there's a lot of questions, of course, but it covers the topic pretty thoroughly. So when you're done with it, you'll be in pretty good shape with comparative advantage. And so then when that's done, so what I would like to do is go over this on Thursday. And then I will create some more problem sets. And at that time, we'll go over those as well. The first midterm, I believe, covers chapters 1 through 4 or 5. I'll have to double check that. What I really ideally would like to do, I think it is 5, 1 through 5, or 2 through 5 rather. This way, the first midterm is 100% based on international trade, and then we can have a second midterm and a final, which are based on international finance only. I think that makes the most sense. So that means we basically need problem sets for all these chapters that we've been doing in the beginning of the course, 2, 3, 4, and 5, and then we can have what's called a sample midterm, where we actually have everything together in one place, and then we can practice them all together, and then we'll be ready for the first midterm. All right. So that should take care of it. So people have been wondering when the first midterm is. It'll be fairly soon, but not.
Professor?
Yes, go ahead.
So for the format of the midterm, should we expect it to be the format of the problem sets? Are they going to be multiple choice?
Well, the sample midterm will be very similar to the actual test. So that's when you'll get a really good preview of what to expect. But the reality is they're very much like the problem sets anyway. The only thing that's different on the actual test is you might have short fill-in type questions as well as the problems. So, but the problem sets themselves are also excellent ways of reviewing for the exam. So, but the sample midterm is basically almost like a forecast of what the actual test will look like. So if you can do the sample midterm, you'll be 100% set for the actual midterm.
Thank you.
And plus, I'll have plenty of time to do it. Don't worry about that. All right. So anyway, so with all that being said, why don't we get back to where we were, which is chapter 11. Now, chapter 11 is a very long chapter. We're getting towards the end of it. And we've got a couple more very deep and complex topics to cover. And so we'll do that today. And then, like I said, on Thursday, we'll go over this chapter 2 problem set. And if there's still time, then we can go ahead and carry on with the new material. And then the following week, we'll just essentially spend the whole week going over problem sets and the sample midterm so that we'll be finally ready for the first midterm. So, yeah, it's a little late. I mean, usually what happens is when we have a normal spring break, the schedule is a little bit different, because then what I try to do is make sure that whatever exams we're having are all out of the way before spring break rolls along. This year, we don't have that, of course. So it almost doesn't matter when we have the midterms. As far as I know, the only other day off we have is, I think there might be a Tuesday off and a Wednesday off, neither of which would affect us anyway. So pretty much we're just going to be going on until the very end of the semester. So the timing of the test isn't really as important as it normally is. So hopefully this way all your other midterms are done, and so you will have plenty of time for this one. Is that about the size of it? Your other midterms are already finished? More or less? Except for this one, of course.
Yeah, mostly.
I figured as much. That's okay. It's not the worst thing in the world. for this one to be saved to the end, because it could be fairly time consuming. But all right, that's good to know. We're about halfway into the semester now. I mean, like I said, again, forgetting about spring breaks and holidays and all that, I think we're almost exactly halfway through the semester. Our final exam is scheduled for something like, I don't know, May 10th or something along those lines. So this is working out pretty well, I think. All right. Anyways, let's get back to where we were. Chapter 11. Now we're having a very intensive discussion about arbitrage, as you recall. And so, let's see, how far did we get? Let's see. Just want to remind myself how far we got here. We've already looked at the supply and demand. We looked at real exchange rates. Yes, the first arbitrage example we had was just the standard form of arbitrage, which simply means you're buying something that's relatively underpriced and selling something that's relatively overpriced. The difference between those two prices represents your arbitrage profits, but this can only happen if two goods are mispriced in the marketplace. In other words, if somehow the relationship between them that normally holds is being violated. So arbitrage can only happen when markets are inefficient. And yet, as you can probably imagine, in this day and age, where everything's done with computers, this isn't going to happen very often, if ever. But when it does occasionally pop up, there are traders who can find these things, mainly by letting their computers run through all the data and spotting temporary discrepancies between prices. And even then, in order to take advantage of these opportunities, most likely the computers are doing the actual trading because they're fast. Human beings are not as fast as computers, as you know. So you can actually set up a computer and program it so that it will buy and sell based on certain instructions that you give it when it notices any opportunities for arbitrage. So it's still possible to do this. It's just much, much harder than it used to be. I mean, there was a time when you could do this just by picking up the phone and calling people. That was a long time ago. Now, everything is being done with computers. It's just a question of whose computers are fast enough to notice these opportunities before they disappear. And they do disappear very quickly. So we saw how we could arbitrage a mispricing of gold in two markets through a process known as goods arbitrage. Essentially, all you're doing is buying the gold where it's cheaper and selling it where it's more expensive. Now, that again is not something that's very likely to occur, but it's not impossible either. Okay, this one's a little bit more complicated because there is that need to physically deliver the gold into the new country, and that takes up time and money. So that certainly makes it harder to make profits, but it doesn't rule them out altogether. Hedge funds, we did mention hedge funds, good. Hedge funds are set up specifically to look for these opportunities, or at least the statistical arbitrage hedge funds are. There are other types as well, but this is one of the more popular ones. But the problem is that the amount of computing power that is needed to do this is pretty impressive. It's a very big expense for these funds, and they have to be right on the cutting edge of the technology to find these opportunities and then take advantage of them. And even then, they're not always successful. So anyway, triangular arbitrage is the one that we did work through all the way. This is the one where we're trying to look at the relationship between three different exchange rates, one of which is a cross exchange rate. And the example we looked at here was, suppose that the exchange rate between the dollar and the pound was $2 per pound. And within the yen and the dollar, we have 120 yen per dollar. And then the cross exchange rate, which is the yen pound exchange rate, is given to us as 250 yen per pound. Now, you can see right away there's something wrong here, because if you take the two quotes involving the dollar and combine them, you'll get 240 yen per pound. But the quote that we were given in London was 250 yen per pound. So clearly something's wrong here. And that means we have an opportunity to earn an arbitrage profit, but we have to make sure that we set it up correctly. ultimately we're trying to buy something that's too cheap and sell something that's too expensive. So like here, for example, this London quote suggests that each pound that we have can be traded for 250 yen, which is more than they should be. So that means that what we want to do is acquire all the pounds that we can get our hands on and use them to buy, yes, we want to trade them in such a way that we are giving pounds to this dealer and getting yen in return. Okay, in other words, we're selling pounds and buying yen because they're being offered to us at a very good rate compared to what we see here is the implied exchange rate between the two currencies. So it's almost like they're giving us a bargain and we're going to take advantage of it. So when we went through the triangle, just jump ahead a little bit here. If we start, no matter what country we started out in, if we move in the right direction, where we end up trading yen, pounds for yen rather, at this exorbitant rate, then we'll end up with a profit. Okay, so we worked through all the math last time, I believe. And we saw that if we start with dollars, $1 million, we'll end up with about 41,000 worth of profits. If we buy the equivalent amount of pounds and start with those and go around the circle, the triangle rather, we'll end up with profits that are denominated in pounds, approximately 20,833.5 pounds. And then, of course, we saw that we can do the same thing with yen. We start with yen, we'll end up with more than we started out with because, again, we're taking advantage of this misquote. And by the way, let's go back to the beginning for a second. Suppose the opposite had happened, and suppose that this quote in London was too low, 230 yen per pound. Could we have made money then? And the answer is yes, by going in the opposite direction. In other words, starting in the United States, we would have moved across into yen, into pounds, and then back to dollars, and we would have made money because this time the yen quote would have been too low. And so the size of that cross exchange rate quote is what really drives this. In fact, maybe let's do this. Let's throw that in here just to see how that would have worked. Just because it might be fun. And we could use the practice, right? Suppose that instead, the cross exchange rate was too low. In other words, the quote was 230. Let me just copy that from somewhere. And so okay, when the correct value was 240, we already saw that. The correct value, meaning the value implied by combining the yen dollar and the pound dollar exchange rates. Could arbitrage profits still be earned? And the answer is yes, by reversing the transactions undertaken in the first example. What does that mean? It means we do everything backwards. Okay, so let me get the graph going here and we'll just see how that works. All right, so we'll go back to the top. The first graph that we had, we went in a clockwise direction. Now we're going to do the opposite, and we're going to see that it actually makes us some money. All right, so, yeah, you know what I have to do here? I don't, you know what, I'll tell you what, let me just draw it again. I thought I could kind of rescue it, but I don't think so now. We'll start down, we have down here dollars. Up here we have pounds. And down here we have yen. We start with $1 million US. Now the exchange rates are still $2 per pound. Here, down here, we still have 120 yen per dollar. But what's different is that the cross exchange rate over here is, instead of 250, it's 230 yen per pound. 230, okay, yen per pound. So that means that you can buy British pounds with only 230 yen when it should cost 240. So that's exactly what we're going to do. We're going to buy pounds. We're going to take all the yens we can get our hands on and use them to buy pounds. But in order to do that, we have to acquire yen by moving in this direction. And so here, what you have to do is multiply the dollars by the yen to come up with 120 million yen. Now here I'm going up and converting all my yen into pounds. Now the math here is to take the 120 million yen and divide by 230 yen per pound. All right, so if you divide 120 million by 230, you'll end up with 521,739.13 pounds. Now, we don't want pounds. We're an American trader. We want to convert those back into dollars. Each pound is worth $2. So we're going to take over here this number and multiply it by $2 per pound. And that's going to give us 1,043,478.26. So remember, we wrote down here, this is the starting point. So we finish with 1,043,478.26. So our $1 million has now been suddenly converted into 1,043,478.26. That's an arbitrage, okay? And again, but how did this happen? Because look what we were able to do. This exchange rate we were offered represents a number that's too low, meaning that it's almost like they put the pound on sale. We were able to use too few yen to buy a pound, which means that our arbitrage comes about by using yen to buy these pounds because the price is too low. As long as that happens, the rest of this takes care of itself. Okay, so in the beginning, we just converted our dollars into yen at the appropriate exchange rate. We traded yen for pounds at the inappropriate exchange rate. That gave us too many pounds. Had this been the correct value of 240, I'd only have 500,000 pounds here, and then that would work its way back to the US as $1 million. But because it's 230, they're giving me too many pounds for my yen. And now I convert them back into dollars at the correct exchange rate. And what do you know? I have a profit. So this is what we mean by triangular arbitrage. And this is what keeps these exchange rate consistent with each other, because the quotes can't deviate too far from these numbers. And especially when you think about it, I'm the trader in the United States. Whoever gave me this quote in London just lost whatever I gained. Okay, they're the ones who are losing money. That's where this profit is coming from the dealer who gave me the bad quote. They won't survive for long if they keep doing this. So you can rest assured that they're going to do whatever they can to give out correct quotes. Otherwise, they'll go out of business. Especially now in this day and age where the computers will notice it immediately if something's wrong. All right. Well, now we've got our third and final form of arbitrage to deal with. This one is very different because it involves not cross exchange rates, but spot and forward exchange rates. Okay. So in other words, it turns out that there is a precise mathematical relationship that must hold. Let me just do something real fast here. That must hold between the value of a spot exchange rate and the corresponding forward exchange rate. What is that precise mathematical relationship? Well, let's find out. Let me just put this away. Okay, so let's jump ahead and look again at our discussion about what's called interest rate parity. Here it is. So interest rate parity is the mathematical relationship that holds between spot and forward exchange rates. It turns out that it is driven by interest rates and time, as well as the spot exchange rate. Now, let's take a look at this thing. Now, this is where we didn't we look at a video last time about the euro currency markets? Was that this class? Okay, I thought so. Good. So you already know what euro currencies are. That's important because these two rates are euro currency deposit rates. All right, that's good. So, and you already know the sad story of LIBOR that's disappearing because the traders were crooks. Oh, I think we must have mentioned that too. Huh? All right, that's good. So this is the relationship that must hold between the two. And as it turns out, if this relationship is violated, there will be arbitrage opportunities. The question is how? How do you take advantage of these? All right, so let's say, well, first of all, here's the formula. And let's just quickly review what it means. So we have E is, we'll use the dollar pound exchange rate. Now, of course, remember, spot exchange rate simply means it will be delivered immediately. I need pounds right now. I pay the spot exchange rate. And then F is the forward exchange rate. Actually, let me be more specific than that. This is the so-called end-day forward exchange rate because a forward exchange rate has a maturity date attached to it. That refers to the date on which the currency is actually delivered. So we have an end-day forward exchange rate. Okay, now N, as you recall, we discussed this too, I believe, is based on a 360-day convention. Okay, so there's different ways that interest rates can be calculated. There's about 4 or 5 that are standard. This is one of them, 3360. So that means each month is treated as if it had 30 days, and each year is treated as if it had 360 days. So if, for example, we have a 90-day forward exchange rate, that would be the equivalent of a quarter of a year, basically. So then we have R. That would be the euro dollar deposit rate. And then in this case, R star is the euro sterling. The prefix euro simply means outside the country of origin. And who remembers why the pounds are called sterling as opposed to euro pounds? Why are we calling them euro sterling? What was the reason again? Okay. We did go over that, right?
Yeah, that's the actual name. The
Yes,
great
that's correct.
crown.
The correct name of the currency is the pound sterling. So we must be very precise here. We call it euro sterling. And it dates back to, as we saw in the Wikipedia article, the time of the Anglo-Saxons when they defined the pound as literally a pound of silver. Anyway, so then the less detail, no, everything's covered here. So this is the exchange. Now, this is what we mean by interest rate parity. When you hear the term interest rate parity, it refers to this equation. And unlike many other parity equations, this one is we call it a no arbitrage relationship, because if it is violated, that means traders can earn arbitrage profits. Not all relationships in finance are no arbitrage relationships. This one is one, though. And we're going to prove it. We're going to show how to make money if we have a situation like this, where this forward exchange rate is not the one that's being quoted to you. All right, so we have an example here with some specific numbers. So we're going to plug them in. We have a 180-day euro-dollar deposit rate at 2.89%. 180-day euro sterling has a rate of 4.7521. And the spot exchange rate is assumed to be 1.86. Of course, that's well above where it is now. But the thing about currencies is that they're so volatile that by this time next year, it may very well be that this is the right exchange rate. Who knows? The pound, within the last 10 or 15 years, it's been as low as $1.02 and as high as $2 and some odd cents. It just goes up and down like a roller coaster. All currencies are like that. They're very, very volatile. Anyway, so if we plug in the numbers into the interest rate parity condition, we'll come up with what's called the implied 180-day forward exchange rate. This just means consistent with interest rate parity, which also means consistent with no arbitrage. If you're given that quote from a dealer, you would not be able to earn arbitrage profits off of that dealer, because this is the rate that is correct and prevents arbitrage opportunities. All right, so we plug in some numbers and this is what we get. So if you noticed, the spot exchange rate was 186.93. The forward exchange rate is lower than that. So that means because we're waiting 180 days to take delivery of these pounds, it's actually getting cheaper to buy those pounds as we look further and further into the future. So F is less than E. And the reason for that, algebraically, is because the US rate is less than the euro sterling rate. So clearly, if it was the other way around, then if the US rate was higher than the UK rate, then you would have F be higher than E. So you can tell when you look at the pattern of forward exchange rates, which country has the highest interest rates. Now, last time we tried to find some quotes on the Wall Street Journal and we were not successful, which is very frustrating because I'd like you to see what they look like. And I don't understand why they don't show them anymore. Because they used to. In fact, you know what, I'll tell you what, let's give it one more shot. All right, so yeah, see, those are the spot. This is spot only. I don't know what's going on with these people. No, that's a converter. Oh, wait a minute. No, these are cross exchange rates. I don't want these. It's kind of nice of them to do this for us, though, I must say. Like for example, here you can see very quickly and easily, it takes 1.7344 Canadian dollars to buy a pound. that kind of thing is very helpful. But I was hoping to find some forward exchange rates. Man. Uh-oh. Uh-oh. I guess they don't want me to see it. Okay. Oh, okay. I don't know what that is. Yeah, maybe I can find it somewhere else. Let me just quickly look. Maybe Bloomberg has it. Oh, this is a Bloomberg terminal. If you end up working in finance, you might end up having one of these on your desk. No. I guess not. All right, but let's just say that as an example of this, let's just say that we looked in the Wall Street Journal one day. What you might find is something like this. Let's say it's $1.60 per pound. Let's just make up an example. And then we start looking ahead and we see the rest of the forward exchange rate. So 30-day, it would look something like this. To 60-day, let's say, is $1.64, just to keep it simple. It's not going to be quite this simple, but let's just say this is what it looks like. And then let's say 90 days is 166. All right, so you can see what's happening here. There's a pattern. So typically the pattern is either rising or falling. That's pretty normal. So based on the logic we had here, the forward exchange rates are actually rising above the spot exchange rates as we go further into the future. And that implies that, unlike what we saw here, this means that the Euro US, or we could say Euro dollar rates, are greater than Euro sterling rates. That's what it means. That's how we can tell. Because, and we'll see why when we look at the arbitrage, but the relationship is driven by interest rates primarily. The maturity too, if you look at them, you'll notice that as the maturity increases, then discrepancies will increase as well, which makes sense because we're holding the money for longer periods of time. But the bottom line is those interest rates, because ultimately these forward exchange rates are telling us at what exchange rate show the exchange rate at which investing in Euro dollars or Euro sterling provide the same rate of return. Except now we have to be careful here for an American investor. Investing in Euro sterling without bearing foreign exchange risk can only happen, or can happen, if the proceeds of the Euro sterling account are sold for dollars through a forward contract. Okay, so that's why that forward exchange rate is related to the respective Euro currency rates, because it is the only rate at which the returns are equal after we hedge our risk in the foreign currency. All right, so I think we have a good example of that right here somewhere. So using the numbers we had, 180 days, domestic rate, the euro dollar rate is 2.89%. The euro sterling is 4.75 to 1%. And then these are the spot and 90-day, 180-day forward exchange rates. So if you start out with $1 million in a euro dollar account for 180 days, it's very easy to determine that you should have $1,014,450 in 180 days. Now, how did we come up with this? Well, you've got $1 million that you multiply by 1, which represents the return of principal. Now, the interest is here, but if you notice, this is not a 1-year investment. So we've got the annual rate of interest. This is the actual fraction of a year over which the interest is being earned. In this case, it happens to be half a year. So instead of getting 2.89% on our investment, we're getting half of that, 1.445%, which on $1 million means that when the 6 months are over, our account should have grown to $1,014,450 US dollars. Now, of course, because we're Americans, this is fine. We want dollars. We are not bearing any foreign exchange risk. But if we do decide to move our funds into euro sterling, we do not want to bear any foreign exchange risk. So we have to simultaneously enter into a forward contract, which enables us to trade all of our euro sterling for euro dollars at the end of the 180 days. And that's the only way to guarantee a specific rate of return. And that's the role of the forward exchange rate in these transactions. It's a hedge against foreign exchange risk for the foreign investor. All right, so how would that work? Now, this is obviously a lot more complicated. We'd start with our $1 million, and we'd have to first use them to buy pounds. Once we have those pounds in our hands, we can put them in a euro sterling deposit account. But at the same time, we know now when we do this, how many pounds we will have in 180 days. There's no mystery about that. So we figure that out, and we enter into a forward contract in which we agree to sell exactly that many euro sterling for dollars at whatever the quoted forward exchange rate is. So therefore, we know exactly how many dollars there will be in dollars in this account in 180 days. There's no mystery about it. There's no risk. All right, so we know exactly how many there will be because we've eliminated all of our foreign exchange risk. Okay, so we sell pounds forward through a forward contract to avoid this risk. Otherwise, we're just gambling. So in this example, we started out with $1 million. Now we're going to convert them to pounds using not the forward exchange rate, but the spot exchange rate. Now, this is always a big question. When you are converting one currency into another, how do you know if you should multiply or divide? It can be a constant nuisance if you're not understanding how this works. So let's see what we're going to do here. We'll start with $1 million US, and we're dividing by 1.8693 per pound, which is equivalent algebraically to multiplying by the inverse of that, And now by writing it this way, you can see the dollars cancel out and we're left with this number of pounds. Okay, so if you weren't sure whether you should multiply or divide, you can write them out like this and see which currencies cancel out, if any. And if you're left with the right units, that means you must have done it correctly. If you've got the wrong units, well, it means the opposite. Now, once we have that many pounds in our hands, we're not going to use them to, throw them into our drawer. We're going to invest them for 180 days in a euro sterling account, which is not difficult. Any major commercial bank in the United States can handle euro currency deposits. So we know already today what the euro sterling rate is, and we can tell with perfect certainty that by depositing these pounds into this account for 180 days, we'll end up with this many pounds in 6 months or 180 days. It's guaranteed. Now, at that time, we will not want to sell these at the spot exchange rate because it could be anything. We could make money, we could lose money. We don't want to deal with that kind of uncertainty. So today, we'll enter into a forward contract. All right. So today, we enter into a forward contract to sell all of them 547 670.52 $4 at, and the forward exchange rate, remember, was quoted to us as 1.8523. So what does that equal to? Let's find out on the next slide. So except for maybe some potential rounding issues, that works out to $1,014,450. Now, that's what we got from investing in euro dollars. So that's kind of interesting. In spite of the significant differences in the interest rates between the two countries, investing in them without any foreign exchange risk gives us the exact same rate of return. But that's only because the forward exchange rate is at this value. Now, by looking at this, you can see, and by the way, I forgot to mention here, when we converted these back to dollars, instead of dividing, we multiplied. All right, so let's check this out. So you can see it does give us the right units. And if you multiply this out with your calculator, again, there could be some trivial rounding differences. It's worth that much in dollars. But what if the forward exchange rate had been different? All right, well, let's check out some possibilities. All right, so let's say that had it been too high. So yeah, so the bottom line here is that when F equals $1.8523 per pound, what happens is that the returns to both countries, or both currencies, I guess we should say, are the same. Okay, now, if F had been, let's say, greater than this, let's just say, I don't know, $1.86. What would have been different? Okay, so let's go back here. And what you would notice is that when you entered into this contract, you would have sold the same number of pounds. Okay, that wouldn't have changed because that's dependent on the euro sterling interest rate. 547, 670.52 would then have been multiplied by this excessively high exchange rate. And so this means that you would have ended up with, let's see, 547, 670.52 times $1.86 would have brought us, 1,002,237.052. So what does that have to do with anything? Wait, hold on one second. I'm double checking this. Oh no, sorry, I goofed up something. That's not right. Yeah, that's definitely not right. It's 1,018,667.17. So remember, so that means now that investing in euro sterling provides a return or provides a balance of 1,018,667.17 compared with 1,014,500 or 450, I think it was. Yeah, 450 by holding euro dollars. Okay, so what that means is an arbitrage can be earned by and by the way, one more thing. I just want to mention that this implies, I typed this wrong, sorry. A quarterly return semi-annual return of, hold on one second. So that means on a quarter, this works out to 0.018667, approximately 1.8667% compared to about 1.4450% with euro dollars. So how do we make money from this? Well, in effect, you're given the opportunity to borrow at a cheap rate in the United States and earn a higher rate in the UK. So the strategy you will pursue will be to borrowing dollars, investing in pounds, and selling pounds forward. To take advantage of the discrepancies. So the logic behind what you're about to do is to borrow in the country with a cheaper rate of interest or where the return is lower, convert them into the higher return currency, and then making sure you get rid of any foreign exchange risk with a forward contract. That's the basic logic behind what you're about to do. On the other hand, what if the rate that we were quoted is too low? Okay, the forward exchange rate is lower than it should be. What happens now? Okay, well, you can probably tell already. It'll just be the opposite. All right, so if it's too low, let's say $1.85. So now look what happens here. When we convert those pounds into dollars, we're only going to wind up with, let's see how much. 1,013,190.46. All right, well, that's too low. That's less than we would have gotten by keeping our money in euro dollars. So in euro sterling, it gives us, okay, 1,013,190.46, where the return is therefore only about 1.319%, compared with 1.445% in euro dollars. So now you can see we're going to reverse everything. We want to borrow pounds, invest in dollars, and then interestingly enough, we're going to sell dollars forward for pounds. In this case, our profits will be realized in euro sterling rather than euro dollars, but it's still a profit. All right, so in a nutshell, let's summarize this. If F is too high, what are we going to do? Borrow dollars, invest in pounds, and sell pounds forward. What did I just do? All right, here we go. Oh, one more detail. I forgot. I almost left out one of the most important things. Let's go back here for a second. Yeah, I left out one detail here. When you borrow dollars, invest in pounds, and sell the pounds forward, you still have to repay the dollar loan. Okay, I just realized I left that part out, that little detail. But when you do that, you'll still end up with a profit. Okay, so you'll have something left over after you repay the loan. And then down here with this strategy, it's the other way around. Okay, so here we borrow pounds, invest in dollars, sell dollars, and then also you have to repay the pound loan. That has to come as well. In other words, you borrowed money, you have to pay it back in the same currency, but we will still end up with a surplus when we're done. Okay, now it's okay. All right, so the summary chart is fine. Now let's move this over here. If F is too low, which we just saw a minute ago, we lend dollars, borrow, actually, no, sorry. Let's do it this way. We borrow pounds. That's probably the better way to explain it. Invest in dollars. Then we're going to sell dollars forward. And finally, when the dust settles after all of this, we're going to repay the pound loan. Okay, so that should do it. So that's in a nutshell what we're about to do. Now it's just a question of showing what the steps are. But hopefully you'll see the logic behind why this is happening and why it's not likely that this will ever actually happen. Okay, so there's only two possible. Now, the only possibility that's left is that these are equal to each other. I mean, if F is at the right level, then clearly there won't be any arbitrage opportunities, will there? Okay, so we're going to have a diagram which explains why this is happening. And then we're going to look at some numerical examples of how to take advantage of arbitrage opportunities and how much money we can actually make. All right, here's a diagram from the original case when everything was fine. The forward exchange rate was exactly equal to the implied value. So over here on the left, you start with $1 million, which we can borrow. Actually, in this case, this is not the case where we're borrowing. This is just here to show that the returns to the two currencies are equal. So there's no borrowing here. We're assuming that we have the $1 million to start with. Okay, so in other words, we have $1 million here, which we can now invest for 180 days at 2.89%, as we've already seen. That means that we'll end up with, hold on. Yeah, that's right. $1,014,450. That's the easy one. Now, if instead we decide to invest in euro sterling, we convert them at the spot exchange rate. And again, let's remind ourselves, this is a division. And if you take out your calculator, you'll see that this does in fact give us, within, rounding, of course, to pounds and pence, 534,959.61 pounds. This can now be invested for 180 days at the euro sterling market rate of 4.7521%. And by the way, don't forget too that this is only for a full year. We're actually only making half of that. So in other words, this number down here is the result of taking 534,959.61 pence. And we multiply it by 1 plus, convert this to a decimal, and then we have to multiply this by 180 over 360 to remind ourselves that this is only a 6-month investment, and that's where we get this number from. Now, presumably, we also simultaneously enter into a forward contract to sell these pounds for dollars using this forward exchange rate. So if you multiply these together, whoops, let me fix that real fast. You'll see that you do in fact wind up back here, again with the potential for some slight rounding differences, $1,014,450. And that just proves that the returns are equal to the two currencies when the forward exchange rate is at its correct value. Correct meaning the rate that is implied by interest rate parity. That's the key to the whole thing right there. But we've seen already that, well, you know what? If F is off a little bit, we can make some arbitrage profits. The question is how? And it's a little bit more complicated than triangular arbitrage, but not much. There's 4 parts to this diagram instead of 3, that's all. Okay, so this now, interestingly enough, even though the condition is called interest rate parity, the name of the arbitrage that takes place if it's violated is called covered interest arbitrage. The word covered means the foreign exchange risk is hedged. And keep in mind too, I think I forgot to mention this before. In order for this to be an arbitrage, it must be risk-free. Okay, arbitrages are risk-free. And the only way to guarantee that that will happen is if we've covered or eliminated our foreign exchange risk. So here, the way we get rid of that risk is by using a forward contract to get rid of that risk. And so the result is called covered interest arbitrage. Now, here's our first example. Now, we saw earlier that if F is too high, we'll borrow dollars, invest in pounds, sell them forward, and repay the loans. So here we have F equals 186. It's too high. All right. So what are we going to do? Now, this is sort of a simplified version. Let me copy this back in here so we can confirm that this is being carried out correctly. Oh, it's a complete mess. Hold on 1 second. So this is how we described it earlier. Borrow dollars, invest in pounds, sell pounds forward, repay the loans. So down here, I've written it as buy spot pounds. That would be this. And then selling forward pounds is this transaction. So this just leaves out the fact that you're borrowing the money. Now, if you already have this money in your pocket, you don't even need to bother with the loans. Okay. So in other words, this is assuming that you don't already have this money. But if you do, you have to borrow the money and pay it back. If this is coming out of your own pocket, even those two steps are not necessary. But remember, what are we trying to do here? F is too high. It should be 185.23. So what that means is here, we are paying too many dollars for each forward pound, which is the equivalent way of saying forward pounds are overpriced. And if they are, then that means that spot pounds are underpriced, which I have no room for. Hold on 1 second. So that implies, I'll sneak it in here, spot pounds are underpriced. And therefore, we're buying the spot pounds and we're selling the overpriced forward pounds. That's why this is happening. All right, so let's watch this happening on the diagram. So here's what we're going to do. Borrow $1 million for 180 days at the euro dollar rate. Immediately convert them into pounds like we did earlier. Deposit them. These pounds have to go into a euro sterling account in order to earn interest. I can't leave these in a dollar account. It has to be euro sterling. And we already have seen the rate at which I'll earn for that 6 months. We already know that this will provide me with this many pounds in 180 days, which I can then immediately sell. Oh, sorry, not that many. this many. This will be the deposit, the amount in my balance in 180 days. I will sell all those pounds forward at $1.86 each. What will that bring me? Well, I'll give you an advance hint here. If you multiply these together, you'll get 1,018,000 $667.17. That's how much we'll get from that contract. If that's more than it costs to repay the loan, we will make money. And we'll see that that's exactly what's going to happen. All right, so we're going to use the diagram to show this. So the diagram is a very helpful tool, as you can see. So again, we convert our $1 million into this many pounds. We deposit them in the euro sterling market for 180 days and get this many at the end. Now, here's where the profits are. I'm taking all these pounds and selling them at a very high price, and this is what I end up with. As we've just seen, how much did it cost me to borrow this money? 289% for 180 days for $1 million means I must repay only $1,014,450. So the profit that I just earned is the difference between the two. And I subtract off what I paid. Wow, not bad. $4,217.17 goes right into my pocket. Interesting. Now, if F is too low, we'll just go working this backwards. Now, here's what I would like you to do. Now, besides the chapter 2 problem set, here's what I think we should do, just to make sure you're catching on to this stuff. Why don't you do this? And the answers are not here. I mean, the instructions for doing this are here, but not the final results. Let's just say, assume that F only equals $1.85 per pound instead of where it should be at 185.23. All right, so what I'm going to do, hold on one second, show how arbitrage profits can be made with covered interest arbitrage. All right, so in other words, this is my challenge to you. What you're going to do is follow the same logic and figure out what the profit we would make if F is equal to 185, but you also have to explain what steps are being made or followed what steps are needed to take advantage of this arbitrage opportunity. Okay, so why don't you work on that? I mean, between now and, well, actually, you know what? We've got some time. Why don't you do it right now? Why don't you take out a piece of paper and just follow what we've been doing and see if you can come up with the number of pounds, by the way, it'll be pounds, that you'll earn by exploiting this mispriced forward exchange rate. All right. Yeah, all right, I'll tell you what, let's not wait till next time. Let's do it now. Okay, so why don't you take a few minutes. So what I'm going to do is put back up in the screen this diagram so you can see what has to be done, except you have to reverse it all. Okay, so let me copy it again down here. So remember to go in the opposite direction. And also remember that F, let me make a few changes here. Change this to 185. And you can get rid of this. And ignore the arrows. They're going the wrong way now. Okay, so basically, start at the beginning. Start with $1 million worth of pounds, that is, and work your way around this diagram and see what you can come up with. All right, so I'll give you a few minutes to take care of that. We'll see how you did. Damn it. All right. So let's see. Maybe we could just do it all over again. So I'll try to use this as the starting point. It's a little awkward to try to recycle this with all those arrows there, but so we would start in the bottom left-hand corner. You borrow the pounds this time, all right? So remember, let's go back and revisit our chart. When F is too low, then we do the following. All right, let's see if we can get that. All right, I'll just copy the whole thing. That's fine. So in a case like this, so we're going to borrow the pounds, which means we'll start in the bottom left-hand corner. To be consistent, we're going to keep the same number of pounds. In other words, $1 million worth of pounds. So we're starting down here. 534, 959.61. And then we're going to convert these into dollars at the current spot exchange rate of 1.8693. And we'll have ourselves $1 million, which we now deposit in the euro dollar account for 180 days. And we already know that that's going to bring us $1,014,450. But now we're selling these for pounds at the overvalued F equals 185. And so what's going to happen is that we will collect at the end, okay, 1,014,450 is divided by $1.85 per pound to give us 548,000. $351.35. Actually, let me make that a little neater here. $548, $351.35. Now, here's the thing, though. We have to repay the the pound loan. So that's going to cost us 4.7521% in the euro sterling market, but only for 180 days. And so if you multiply that out, you'll get 547, 670.52. And guess what? Just as we predicted, I'll sneak it over here somewhere, the profit is the difference between the two of them. Let's see, what is that? 547, 670. All right, so we made 680 pounds. And let's say 83 pence. All right, now that's not a lot of money, but I mean, the F is only off very slightly. It's just a little too low. It was supposed to be 1.8523, so it's really not that far off, but it's far enough off that we can make a risk-free profit by borrowing sterling and investing in dollars. And that's all we had to do. Now, of course, we always cover our foreign exchange risk with a forward contract, and we repay whatever currency we borrowed. But the bottom line is that when we're done, we're going to wind up with a profit. And again, this little chart is really the way to go. In other words, if you're not sure, this is how you know what to do to make a profit. Okay. This is a very valuable chart, I think. In fact, I should copyright this thing. This is summarizing in a nutshell how you make money with covered interest arbitrage. Man, so that's, maybe it's a little more complicated even than triangular arbitrage, but once you've done a few of these, it's really not that difficult. All right, now there's one more topic in here, which is really kind of misnomer. It used to be that this was a popular strategy, not so much anymore. It's possible to make money sometimes. Let me just briefly introduce this topic. In some situations, it may be profitable to borrow a currency with a low interest rate and invest in a currency with a high interest rate without covering the foreign exchange risk. Although this is a risky strategy, it does not require the forward exchange rate to be misaligned with the spot exchange rate. So this used to be much more common than it is now. And so this type of situation, which is not strictly speaking an arbitrage at all, although it can sometimes be called that, and I don't know why, because it's not technically accurate, but this situation is known as uncovered interest arbitrage. It is called uncovered because we're not using a forward contract to eliminate our foreign exchange risk, which means that it is not, whereas technically not an arbitrage. But the media always referred to it as uncovered interest arbitrage anyway. It's a very we'll see next time. We'll do this. We'll go through this chapter 2 problem set next time, and then we'll wrap up this topic with our uncovered interest arbitrage, and then maybe we'll take a peek at the next chapter. The following week, we'll spend the whole week going over problem sets and reviewing to get ready for the final exam. Okay, so chapter 12 is kind of an extension of 11. What's different in 12 is that we're trying to really have a better understanding of where exchange rates come from in the first place. Not so much the arbitrage situations, but what factors are responsible for the behavior of exchange rates. All right, well, anyway, so I guess we'll stop right here, and we'll carry on next time with, don't forget the chapter 2 problem set, and we'll carry on with that, and we'll finish up this chapter, possibly start chapter 12, and then, like I said, I'll have more problem sets for you by then that you can do during the week and have them ready for next week.
Right. Professor, I checked the chapter 2 problem set, and we've already done that in the beginning of the semester.
I know that, but you need the practice, don't you?
Okay.
It's just practice.
Yes.
It's just review for the midterm. It's not meant to be new.
All right.
Okay. Well, I'm glad you recognize that. That means you'll be able to ace it, right?
Yeah.
Are you sure? Well, after a little reviewing, maybe. Okay. So no, I think it's good practice to go back revisit this stuff because you'll see it on the midterm anyway. All right. Does anyone else have a question? All right, then I'll see you all on Thursday.
Thank you.
All right, see you later.